Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent Consumer Price Index report, or CPI report, with regards to headline inflation and core inflation. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the newsletter. It is free. You can find a link to it in the description below or the pinned comment. Let's go ahead and jump in. So, inflation is something that we continue to monitor relatively closely. And the reason is because we know from past experiences that high inflation does typically push us into a recession. You can see this orange line sort of going through the chart here. This is the inflation data, and then overlaid, the blue line is the S&P 500. And what you'll notice is that periods of high inflation tend to lead to tumbling markets. This is just the way it is. When people are worried about how they, how like about the price of everyday goods and services, it makes it less likely that they're going to put this money into risk assets just because their disposable income is a lot less. This is also hitting businesses relatively hard as well because of rising interest rates by the Federal Reserve. Now, where did we come in on this CPI report? Well, it turns out that headline inflation dropped just a little bit, but it only dropped from 8.3% last month to 8.2% this month. This is not a substantial decrease, okay? And the Fed's going to look at this and say, well, it is coming down, but it's not really coming down that quickly. It's still at 8.2%. Furthermore, consensus was at 8.1, which was not that of an optimistic consensus for it to still be over 8%. And despite that, it still came in at 8.2%, a little bit over the consensus estimate. Of course, markets do not like this. Furthermore, the more important thing that is worth watching, and what I think the Fed cares more about, is the core inflation rate. We have now put in a new high for this business cycle with regards to inflation. Inflation earlier in the year hit 6.5% with respect to core inflation, which excludes food and energy. We have now gone to a higher level on core inflation. Now, what's interesting, I want to talk about this a little bit because if you follow me in the Cryptoverse, you're fully aware of double peaks, right? I mean, you've seen double peaks. It's like everywhere. Bitcoin USD double peak in 2021. Ether Bitcoin double peak in like late 2021 and early 2020 and in mid to late 2022. We've seen plenty of double peaks across the entire asset class. With altcoins, we've seen it even with equities as well. And what's interesting is you're also seeing the same thing play out potentially on core inflation, right? A double peak where the second peak is slightly higher than the first one. It's interesting how you see sort of the stock market and cryptocurrencies sort of like foretells what's happening with respect to incoming data with regards to inflation. But listen, I mean, core inflation now is at 6.6% year over year. This is higher than consensus, and despite the Fed's best efforts to bring inflation down by raising interest rates, it hasn't done a thing for core inflation. It's still relatively high. Now, why is this? Why is this? Well, as we've said before, it takes about 12 months for interest rate hikes to really filter through the economy. Now, the markets are forward looking. Okay? I mean, markets price this stuff in well ahead of time. It's not like the market has to completely wait and see for every last business to come underwater before the market goes back up. That's not true. But what is true is that there still is fear that inflation expectations are not coming in where they should. Inflation continues to run very, very hot, and the Fed is likely going to have to keep raising interest rates because we've listened to their prior talks with Powell, and he's been very adamant that he understands that it's causing pain to businesses. But he's also been fairly adamant that despite this pain, the alternative of entrenched inflation would be worse. Okay, so this is something that we have to consider. So again, core inflation's coming in at 6.6%. How do you think the dollar is responding? It's up to 113.6. I mean, the dollar remains relatively strong despite Despite the fact that that inflation is high, it's sort of counterintuitive, I think, to a lot of people. But as we've said before, and for the entire year, cash is king, right? Cash is king this year and has been king for the entire year. And there doesn't really have to be any mental gymnastics going on to figure out why it's king or why it's not. It's just simply the Fed will remain hawkish, and therefore risk assets will continue to be under a significant amount of pressure. Furthermore, the other interesting thing I think worthwhile to look at is, where do you think the interest rate hikes are going to be in November? One of the things we discussed in a prior video is that the 50 basis point rate hike probability might go away after we get new inflation data if it comes in hotter than expected. And in fact, it did. Now the market says there's a 0% chance of a 50 basis point rate hike in November, and in fact a 97.8% chance that we get our fourth 75 basis point rate hike in a row, with only a 2.2% chance of it being a 100 basis point rate hike. And then finally, in December, if we get 75 basis points in November, there's now a 61.8% chance that we get another 75 basis point rate hike in December. Markets are now finally pricing this in, that what if we have, not just 3 75 basis point rate hikes, but what if we have 4 or 5 75 basis point rate hikes? And then what's also interesting is, if you go to the end of the year, there's now a small probability of 1.4% chance that we end the year at 5% for the Fed funds rate. And then going into February, I imagine it's been propagated out further, and you'll see there's even a 0.2% chance of it being 5.5% by March. I'm guessing it's going to really start to slow down here and not go much higher according to market expectations, but we'll have to wait and see. 0.1% chance that it'll be 5.75% by March. And then if we just sort of skip ahead to July, let's see where July is coming in. Yeah, it's about the same. So you can see that this most recent inflation data has continued to drive up expectations as to where things might be. It's actually coming in 5.5% in July. But again, these things are going to change a lot over the coming hours as markets continue to sort of figure out what will likely be the Fed's response. And so this is something that I think is worthwhile to consider. I mean, by summer of 2023, the market is saying there's almost a 44% chance, the highest probability for any individual range here, that the Fed funds rate will be 5%. So inflation has still not come down. It's potentially showing a double peak, kind of like we saw in a lot of markets back in 2021, and some of that bled into 2022. It takes a long time for this stuff to come back down. But I do imagine they will finally get what they're looking for as we get out into 2023. Okay, I think that it'll finally start to come back down, and then the Fed will, at some point, they'll start lowering their interest rate hikes. Then they'll completely pause it, and then we'll have to wait, and then we'll have to see how bad is it. Does it kick us into a full-blown recession where unemployment starts to really push higher? I think it probably will. I know a lot of people would say we're already in a recession, and I completely understand the academic arguments for that, especially with 2 consecutive quarters of negative GDP. But the truth is unemployment remains low. We still don't have the inversion of the 3-month and the 10-year yield. And so it makes sense to assume that markets have not completely priced in a full-blown recession, considering that unemployment is actually at basically historic lows for at least the last several decades at 3.5%. I mean, you have to go all the way back to like the 70s or the 60s or something to find unemployment rates lower than where they are today. So certainly a lot to digest for financial markets. Again, to recap, the core inflation rate came in at 6.6%, which is higher than consensus and also a new high for this cycle. The headline inflation was technically lower than it was last month, although only barely below it, and still it came in above expectations. The Fed funds rate projections are now looking at no longer any chance of a 50 basis point rate hike in November, but likely going to be 75 basis point rate hike with another small chance of a 100 basis point rate hike. Again, the market's also saying we're likely going to have another 75 basis point rate hike in December as well, which would get the Fed funds rate up to 4.75% by the end of the year. And then, of course, the response by financial markets. If we go look at the dollar, you can see the dollar does, of course, like this news. It's coming in at 113 or so. Bitcoin is down close to 18K. Ethereum's down. Futures are down. Really no surprise. And I mean, we'll continue to follow this as it continues to evolve. And you can see the 2-year yield is now up to about 4.5%. So the yields are obviously up. Equity markets, risk assets are generally down. The dollar is up. All of this makes sense from a fundamental perspective. Of course, we'll continue to follow it very closely. If you guys like the content, make sure you subscribe to the channel. You can give the video a thumbs up, and also check out our premium service, Into the Cryptoverse Premium, at intothecryptoverse.com. Thank you guys for tuning in. See you next time. Bye.